But if we hadn't done that, this deal would have been a disaster.
Because there might be further expenses. They might have to end up doing some sort of remediation.
Yeah, and who knows how long this is going to last. And if I knew 3 years ago that we would still be messing with it 3 years from now, I don't even know if I would have accepted the money into escrow, because I still feel like there is some amount of risk.
Sure.
But
you own the property and there's all of this problems,
they're monitoring these wells right now. And like the state of Nevada says, further monitoring required every quarter. They're telling us that.
Well, if the escrow money runs out, then you've probably got to sue somebody.
Well, luckily the agreement we had is that they had to pay out of pocket for the monitoring, and they don't use the escrow for that. And so the escrow is sitting there, and they want that money, so they're continuing to spend.
Okay.
There may be a point where they throw up their hands and they say, we're not going to spend any more money.
That's when you know you're screwed.
Yeah, because then I got to go take that money that's in escrow and hope that it's enough to cover it, and it probably isn't.
All right. Welcome back to How to Invest in Commercial Real Estate. Thanks for joining us. And this week we are back for an exciting topic. And what we want to focus on today, took a little advice from Neil. Sometimes it's not about what we can teach you, but what to kind of stay away from, right? So here's a few things that if you see, you should definitely throw up some red flags. It should definitely cause some concern. And you should definitely maybe take a moment and say, okay, these guys told me to look out for these things. I need to make sure I know what's going on so I don't get burned.
Yeah, I think it's important because people are starting to hit us up. They listen to the podcast. They're asking us questions. I want to get into commercial real estate. And most of the deals that they're looking at, as long as everything goes perfect and there's no hidden issues, the deals will work out fine for them. But the value in our experience comes from knowing, okay, where can I get burned on these deals? What am I missing as a beginner investor? And so today we're just going to be going over, hey, what are some red flags that you need to watch out for when you're looking at a deal that could burn you once you buy it?
Yeah, so I think one of the first ones is we're obviously buying these properties based on the income they produced, right? If you've been watching the show at all, you know that we're buying real estate for the cash flow, right? Not the inherent value of the real estate. So one important thing is you would like to monitor and see how that cash flow is done over a period of time before you purchase it. Like say you're buying it January 1st of 2021. I would think it would be normal and nice to have the 2020 financials, to have the 2019 financials, to have 2018 financials, as much historic data as you can give me to underwrite, show me some historical past of, hey, you say the NOI is $1 million. Have you ever hit that? What's the highest you've ever hit? Is it 600,000? Now I'm supposed to get to $1 million. What is this? What does the historic financial data look like?
Yeah. Well, and what we've run into in the past is sometimes sellers, when you try to get historical financial information, they kind of balk. They don't want to provide it. It becomes a little bit of a sketchy issue with them. And so that's red flag number one, is a seller that doesn't have or doesn't want to provide accurate historical data for the last 2 to 3 years. So you can analyze the NOI and see how that compares to the NOI you're buying. And a couple reasons for that. First, if the property, like you say, was doing $500,000 in NOI 2 or 3 years ago, and then it did 600,000, and then this year you're buying it on $1 million NOI. You've got to understand that transition. What was the cause of that? Because if they've had real problems filling the units, and then they get a big lease, and now you're buying it, you're assuming some risk on today's higher NOI that the property hasn't supported for the last 2 or 3 years.
Yeah, and you can see, if it's multifamily and you see this massive rent increase, right? You could be assuming, they just normally get those rent increases. But when you look at the balance sheet, you realize, oh man, they were giving everyone with a renewal a brand new refrigerator that's stainless steel, a brand new washing machine that's stainless steel. Like that's a $2,500 to $3,000 per door cost that you would have to underwrite for that rent pop, for that rent increase. So it gives you some clarification, like you said, helps tell the story of what's going on. And when you start looking at enough of these financials, you understand what the normal story should look like, right? You understand kind of where the bodies are buried. Anyway.
Well, in retail, if it's up and down, then that could indicate that they've had a bunch of vacancies or people are coming and going, right? And if that's historically what's going on, you need to understand that.
Good point. That leads us into red flag number 2. I don't know if it's number 2 on the list, but let's go to it.
Yeah.
Is historical vacancy. It can be a red flag.
Yeah.
Either in multifamily, it would be odd that you had a good manager that had historical vacancy, because apartments should be leased if they're in presentable condition and they're asking a market rent. So there would have to be an underlying reason why occupancy would ever dip below 85, 90%. If you're looking at a property and there's a 70%, 60% time period, what I think of is either major renovation, they had to kick some tenants out and they were upgrading the units and they should be looking great,
which is fine.
Or there's some inherent mechanical, electrical utility problem that caused massive exit, like boiler chiller, hot water heater goes down, and it's common for the whole property. Something that caused a mass exodus where people were unhappy. On retail, like you said, if the NOI is varying year to year on a retail deal, then what that means is you do have tenants coming and going. That's not necessarily a good sign for the location. It means that they're having tenants fail there, most likely, and then they're having to re-tenant. That is very, very expensive.
So you provided an excellent example of that earlier before the show, and it was, we all know that restaurant in our town that's constantly going out of business, and then a new restaurant pops up with a different concept, and they're like,
it goes out of business.
Yeah, exactly.
It could give insight into that location not being ideal for whatever the use is. If it's a retail deal, like maybe the retailers are struggling for some reason. Maybe the ingress egress isn't good. Maybe the traffic count isn't good. But what's really important is all the expenses that go into tenant turnover on a retail deal, where you lose the income, you have to pay tenant improvement dollars to attract a new tenant, and you've got to pay leasing commission to the broker. All of those things are really expensive, and they may not be on the income statement. They may CapEx those items. And so that's really important to dive into that. Once you see the historical occupancy varying, you've got to then dig in to see, okay, what were the CapEx costs? What dollars did they give tenants to incentivize them to move in? And are they hiding that on the balance sheet? And so let's say, I'll give you a very specific example. Retail, I've got this tenant going in, and as an owner, I want the highest rent possible. So I induce that high rent by offering high tenant improvement dollars for them to build out their space really nice. And in exchange, they're going to pay a higher rent.
Really common in new development, new construction.
But it may not be that it's market rent. Now maybe they're over market rent, and they're only willing to pay over market rent because of all the TI dollars that they were given. And so you've got to then look at that and say, okay, I have risk here because I now have a tenant that's over market rent, because of what the seller did to induce that rent. And when their renewal comes up, I may have a hard time getting to renew at that high rate.
Yeah, right.
Great example.
Or getting a new tenant in at that high rate.
Or if they bail, can I replace it? And now I have a hit to my NOI because I can't replace the high rent.
Yep.
Yeah, and we've talked about this before, but a Starbucks, perfect example, guys. You go out and you buy Starbucks, they're paying $27 a square foot, and they build a new one right across the street. What are the odds of somebody coming in with a coffee shop right across from a brand new Starbucks? I can tell you they're not going to pay the same rent. It's guaranteed.
Yeah, well, and more likely it's like $40 of rent per foot for a Starbucks.
Yeah, and there's another point, right? Like, we tried to buy this retail deal, and we offered, nine times out of 10, we're trying to figure out a cap rate that we can put on this net operating income. And this guy says, hey, net operating income is $500,000, just using a clean round number. I'd take an 8 cap on it. But I think, the vacancy's worth something. So you should pay me $30 a foot for the vacancy. Do you remember this deal? It was
maybe
in Tulsa. And anyway, our argument was, if the vacancy is worth something to anybody, then go lease it to them and get it to produce any income whatsoever, and then I'll be happy to have you pay for it. But that's been sitting vacant for 5 years. It's worth nothing to nobody.
Yeah. So final point on historical occupancy or historical vacancy is you have to ask yourself, if they've been 90% occupied or 100% and then they lose a tenant, no big deal. But if they have historical occupancy lower, it may look like a good deal, high cap rate, low price per foot, but there's got to be a reason. No owner is going to own a property and not fill it. And so if they couldn't fill it, you have to ask yourself, well, why couldn't they fill it? And it's a low vacancy, and you think, I'm just going to lease that space up, but maybe you're not. Yeah. And that's a risk that you're taking on. So you got to get a real good premium for that, because once again, it would have been leased on some level if it was easy.
Yeah.
All right, next point.
So the next one, I mean, just tying this back into the first one, getting historic financials, you know, it's becoming a theme here is big problems that could potentially come up. So we've talked about historic vacancy, right? You walk into this massive, 5,000 square foot, it used to be a Mexican restaurant. To get that leased to anyone but a Mexican restaurant is going to cost a ton of money. You're going to have to demo all of that. You're going to have to get it ready for the new concept. Like you said, you're going to have to pay leasing commission and tenant improvement, obviously. So there's a massive risk for some big dollars being shed. Some big dollars. Another thing we look at immediately is roof repairs and those financials. Are they having to patch this roof every single month? Are they having a roofer come out all the time? Do they have 10, 20? Yeah, there's probably a roofing problem, right? And that's another thing that we're constantly talking about is when you get a deal under contract, inspect the roof. But specifically what we're talking about on this point is big potential CapEx problems. And do you have the cash budgeted? And what happens if it fails and you need to replace it? Where is the money coming from? What does that do to your model?
That's a good point. So that what we do when we look at analyzing those deals is we take all of the big ticket items, which is in retail, it's parking lot, it's roof, it's HVAC, and it's TI dollars for vacant space, TI and commission dollars for vacant space.
Yep.
In multifamily, it could be boiler chiller, it's roof, it's parking, and it's down units. So if you're buying a multifamily, that one of the big expenses you'll have is if they're not full, is they'll have a bunch of what we call down units. And they're units where people have moved out and they're not rentable. And so,
not rentable unit.
And so
spend the money to fix
it may be that you got to spend $5,000 to get that ready. It also may mean that you have to spend $30,000. I mean, does it have cabinets? Does it have appliances? Does it have flooring? Are there issues with the plumbing or the electrical?
So I want to put a big asterisk on this point because for the longest time when we were looking at multifamily deals, we were looking for those sorts of opportunities. So I'm calling them a red flag in this episode because you need to be wary. This is by every means an opportunity, right? Because if you can go in and fix those down units and you have enough cash to make your model work and you can get them rentable and generate an extra $1,000 a unit, let's call it, and the other guy didn't want to mess with that, that's a massive opportunity. You can make some cash there, right?
Yeah, and I'll make a distinction between retail and multifamily on this point. Multifamily is one of those things where if you provide a clean, made-ready unit at market rent, you're going to rent that unit. When I first started into real estate, I was always worried when I bought a house, am I going to find a renter?
Right.
Who's going to rent this? But what I found over the years is, once again, if you understand what the market rate is for that 3-bedroom house or for the apartment building, as long as you have new carpet and nice paint and appliances and everything's in working order and you offer it at about a market rate, you're going to lease that space.
It's not an if, it's a win.
And so on retail, though, that's not necessarily the case because location is so much more important with retail, and it's so much such a bigger deal for a business to decide to open a location to run their business than it is for somebody just to sign a 12-month lease on a temporary apartment. Yeah. And the location is less important for the apartment, because it doesn't need frontage, it doesn't need good traffic counts, and so it's just easier to think about being able to rent the apartment than it is the retail space. So treat vacancy a little bit more seriously on multi-tenant retail than you do on apartments.
Yeah, I mean we bought a center here in Tulsa. Awesome location. And they had this little horseshoe of retail space and it hadn't been rented in a decade. Pretty easy. Your office is there now, right? But when you look at it, there was horrible visibility. There was no parking. It was this massive green space area. And we just immediately thought, what if you just make that parking? You could see it, you could get to it. And since you didn't really have to have a high rent in there, it historically hadn't been leased in a decade. So we didn't give it much weight. So you can get a tenant in there at almost anything. Like, what are you willing to pay? Come occupy my center and pay your triple nets.
$8 a foot.
And just slowly increase with time. And now your office is there. Anyway, it's this nice, beautiful lease space now. But there's probably something, like you said, there's something wrong with it that prevented it from being leased. And another thing, in retail especially, is on multifamily, you change your rates weekly. You can change them faster, you know what I mean, based on your occupancy and based on, supply and demand. Hey, we have 5 vacancies. They're expensive now versus we have 25, we'll take $40 less a month if you just get in, right? Retail, you can't really do that. I mean, you can't just lower your price every month until you get a tenant. It's not really helping you that much.
Yeah, the dynamic is different because, once again, people that are deciding to start a business, they're choosing to be at that location for a host of factors. Population density, traffic counts, we've talked about it, next to a Home Depot, let's say, if that helps them.
And hoping to be there for a long time.
Yeah. And so it's just, they don't make the decision based on $1 or $2 less in rent. So for me, you have to wait a lot longer to fill retail vacancy, but you don't need to like fire sell it and negotiate, down on it, because once again, people really aren't making a decision. Oh, well, it's $10 a foot instead of $11 or $12 a foot, so I'm going to decide to put my business there. They're not making that big of a decision based on that small of an increment.
I would agree.
All right, what else we got?
All right, every deal we buy, we get an environmental inspection. Every single deal, because environmental issues are not going to say that joke. Environmental issues are the gift that keeps on giving, right? It is very hard to get away from them. It is very hard to get a no further action letter is what you're looking for.
It seems like it comes up a lot more often than I thought it would. Either there was a gas station on the corner, there used to be one, or there was a dry cleaner in the center.
Dry cleaner's a big one.
It comes up quite a bit.
Yeah, and if they knew about a dry cleaner there, it may throw a flag. Like, oh, there's a dry cleaner there 10 years ago. Joke's on you.
Well, so guys listening, girls, guys, people listening, here's the deal is you're going to get a phase 1, and that's just an initial look to see if there was ever any potential issues. It doesn't tell you whether there are issues or not. It just tells you if there are potential issues at the property.
It's a couple $1,000s.
Yeah, a couple $1,000, $2, $3, whatever. And as long as you get a clean phase 1, you can proceed, because even if later down the road they find a problem, as long as you have a clean phase 1, the law says that you won't be held liable.
Who's liable then?
That may be state specific. I think that may be in Oklahoma law, may be varying. So just consult with your environmental or attorney expert.
I think there's I'm going to speak out of turn, but some national, we should Google this before I say it, but a national fund that's been set up to handle environmental issues. Okay. And once again, as long as you're taking the appropriate steps to do your due diligence to ensure there isn't one,
right?
And you get a clean phase 1, then I think you're protected from being on the hook, because there was effectively no way you could have known that there was a pre-existing environmental issue. Now, what happens a lot if you have a dry cleaner, gas station, something like that, is that you'll get a phase 1 that says further investigation needed. And so that's the red flag. Okay. And the broker will say, oh, you don't have to worry. This is a no big deal. But it's a big deal. And you need to get a phase 2. And a phase 2 is a more extensive study into what raised the red flag on the phase 1.
Is it more expensive?
It's more expensive.
Shocker there.
Yeah. And so the phase 2 will dig a little deeper, and they'll see, okay, are there any potential issues here?
Yeah.
And the phase 2 will either say, no, you're good, or here's the testing you need to do.
Oh, wow.
And so if you get into a situation where they find that there needs to be testing, it may be that you need to move on from that deal, because it can be the gift that keeps on giving. And I'll give an example just so you know that we've been through this process. We have a deal in Vegas, and we ran into a phase 1. There was some they noted a dry cleaner. Then we did the phase 2. They noted some elevated levels in some of the boring testing they did. And so the broker, the seller, they're all like, no, this is no big deal. I've seen this 1,000 times. You got nothing to worry about.
Yeah, I bet.
And we I don't know. This is a big deal. It's like $13 million deal. And we're like, I don't think we should take the risk on this. We got an environmental attorney on the hook, and he was great. And what we had to do is we wanted to go ahead and close, but we had to negotiate that the seller was going to put up money in an escrow account, and that they had to pay for all of the testing and the monitoring.
Wasn't this like $1 million or something?
Well,
crazy?
it was several $100,000 they put up.
Okay.
And they had to pay, and not until the issue was taken care of could they get that money out of that escrow account.
So it's like a bond. They kind of bonded out of the problem.
Well, we thought, okay, they're going to do some well testing and it'll all be taken care of. We are here 3 years later, and I still get quarterly monitoring reports on these wells, and there still is elevated levels of PCE or some of these other chemicals. I never thought we would be in this position. The only saving grace is that the seller is still paying for the well monitoring, and they still have that money put up in escrow. But if we hadn't done that, this deal would have been a disaster.
Because there might be further expenses. They might have to end up doing some sort of remediation.
Yeah, and who knows how long this is going to last. And if I knew 3 years ago that we would still be messing with it 3 years from now, I don't even know if I would have accepted the money into escrow, because I still feel like there is some amount of risk.
Sure,
but
you own the property, and there's all of this problems.
Yeah, they're monitoring these wells right now, and like the state of Nevada says, further monitoring required every quarter. They're telling us that.
Well, if the escrow money runs out, then you've probably got to sue somebody.
Well, luckily the agreement we had is that they had to pay out of pocket for the monitoring, and they don't use the escrow for that. And so the escrow is sitting there, and they want that money, so they're continuing to spend.
Okay.
There may be a point where they throw up their hands and they say, we're not going to spend any more money.
That's when you know you're screwed.
Yeah, because then I got to go take that money that's in escrow and hope that it's enough to cover it, and it probably isn't.
Knowing that they walked away from it thinking it wasn't enough to cover it.
What about multifamily? Any environmental issues with multifamily? Do you have to do a phase one on the multifamily?
That's a great question.
You can do. In fact, we're in the process of selling some multifamily now, and there was a phase one, and there was a gas station right next to the property line, and so they recommended a phase two. Phase two we did. It came back clean. Okay. So that's great. But multifamily, there's going to be less environmental issues.
Like you said, it was a gas station close by.
Close by, where a lot of commercial, it was a dry cleaner, a gas station, a business that was on the commercial site.
Yeah. Yeah, so I mean, let's encompass that example just super quick. I mean, you have to not only get a phase one, a few $1,000s, you have to get a phase two, which is, $5,000, $7,000, $10,000. You have to engage this environmental attorney. You have to spend more time on legal fees, negotiating it. You have to spend time now, even though it's not your money, it's somebody else's. You still feel like you have potential risk. A lot of money there for a potential problem. And guys, deals are everywhere. I mean, deals are everywhere. You don't have to pigeon, and it's so easy. I do this all the time. We all do it. We love the deal, and we have to get this done no matter what. We have to get it done.
And you try to talk yourself into it. But what we're saying is that's a red flag that you may, especially as a beginner, want to move on from, because there's too many other deals that don't have the red flag, that don't have environmental issues, that you can buy at a decent cap rate.
Yep.
All right. What else we got?
We've touched on this briefly, but NOI changes. It goes back to getting the historic financials. When you have a massive discrepancy in what the NOI is, you're buying it on $1 million NOI, and then last year the seller's NOI on their statements was $500,000. That should cause you some serious concern. And we've bought deals, and we're even looking at deals now that have that happen, where the trailing 12-month financials aren't exactly what the contracted income is. And what that tells me is I need to go read my leases more and make sure this income is solid. I need to do some tenant interviews and make sure this income is solid. Because again, when you've got the historic financials, that it's a burden off a little bit. It's like, okay, these people have paid rent for the past 2 years. The probability of them just stopping as soon as I buy the building is a little less than, hey, these tenants maybe haven't even opened for business. Maybe they're about to open soon. Maybe they have free rent for 6 or 12 months. All of these things. So the NOI could be what they're projecting, but it hasn't ever been that way. Again, that's a little red flag.
Yeah, I agree. And part of what we do is evaluating that and finding it out. We have purchased properties where the NOI was lower in the past, and the go forward NOI we were happy with. But there needs to be a really, really good story on exactly why that is and what happened. One of the properties we've done really well on, it's also in Vegas. It had lower historical NOI, but it, was kind of over. It was built kind of out a little bit away from the city. The city of Henderson hadn't caught up with the property yet, and then the recession hit, and it got foreclosed, and so there was all these problems with the deal. And then another owner came, bought it out of foreclosure, and was filling it up. And so by the time we got it, the historical NOI didn't match what we were buying, but we felt like the area was really coming into its own and improving. So the story was good enough for us to buy it, and it's been a great property. And we haven't had any issues because the growth has continued in that direction.
Well, and the NOIs continue to grow, has it not?
Yeah. And so we're not saying you can't buy a deal that has an NOI discrepancy, but you just have to understand the story and how it applies to you and what you're doing with the property.
So that brings me to the last point, I think, is what you just mentioned right there. It had a massive NOI discrepancy, but the location was phenomenal, right? In a bad location or bad demographics around your location or bad traffic counts around your location, or, if it's multifamily, there's no jobs around your location. There's no reason for anybody to be over here. It's away from everything. It's in a submarket that's too small. It's in a city that doesn't have, or it's very hard to get to, or some of these demographics, you need to pay attention to the location. And I know it's talked about a lot, location, whatever, especially in residential real estate or almost everything, but it's really important. You see these major national brands and they pay a lot of money for that dirt. They pay a lot of money for that location. You think, oh, Chick-fil-A just kills it because they have good chicken sandwiches. Like, okay, it's a mediocre chicken sandwich. They have the best locations every single time. Starbucks, best locations every single time. You see new Dutch Brothers, new scooters coming in. They get amazing locations, right? And there's something to be said about that.
Totally agree. Location, it can save you. A bad property in a good location, given enough time, can become a good property. But the location can also eat your lunch. Yep. If you are in a bad location, it does not matter how nice the property is, especially retail. If you're in a bad location, you won't be able to lease that space.
Yeah.
And multifamily, same thing. Multifamily, the location is less relevant. But if it's in a rough area, what you have to know about the location of multifamily is, like I've said, you will always rent your apartments if you have a market rate asking rent and you have a really clean unit. But the market rate in a bad location is capped. Where in a good location, a hot area, the market rate can go up and up and up with inflation and with demand. But at some point in a workforce housing C-class location, your upside is capped on what those people can afford, because you're never going to get I won't say never. Okay. Over time it could gentrify.
Sure.
But getting tenants that can pay $1,000, $1,200, $1,500 in rent on an apartment, getting them to a workforce housing where there's a lot of Section 8 or government housing, it's not going to happen. And so you have to plan on, hey, my upside is capped here. Doesn't mean you can't buy there. We've made a ton of money buying in those locations.
Sure.
But you just got to know that location delivers this kind of top end rent. And on retail, once again, I would take location and a crappy looking building every day over a nice looking building in a bad location, because retail is just so specific. Businesses aren't going to open in areas that they don't feel like they can be successful.
Speaking from personal experience, if you're trying to buy retail properties, buy stop looking at good properties. The good ones don't make any money. It's very hard to make a good looking retail property make money because the dirt was so expensive. The cost of construction is so expensive. The rent is ridiculously expensive. So you're nervous about backfilling it. If you have a vacancy, it hurts way worse, and your property taxes are way more, and your triple nets are more. And it's just everything about anyway, I'll get off my high horse.
Well, I mean, I don't want to say you can't make money on nice retail. You can. It may be that you take an initial lower return on your money, but it's in such a good location, the appreciation takes over and it goes up in value that way. We are high cash flow buyers. We are high cap rate buyers, and we want high rates of return for our investors. And so it's hard to get those types of returns on the best looking real estate in the city, because everybody wants that. It's less risky, so people pay up for it, which makes the returns come down. So,
well, that is a handful of red flags. There's tons of stuff to look out for there. If you're watching, make sure to get on our investor list. Super, super important. Go to howtoinvestinCRE.tv or the CriterionFund.com or PrecisionEquity.com. Make sure to sign up for the investor list. Name, email, and if you're accredited or not, then you'll get all of our investment opportunities.
Hey, and if you're looking at deals and you want to know if there are any red flags, hit us up. Let us take a look at it for you, and we'll give it a quick overview, and hopefully we can help you find red flags and make sure we save money on your deal.
Love it. All righty. Thanks, guys.